Recently, I have been testing out 1 minute supply and demand, and let me tell you guys, it hits. Just watch. All the trades that you guys just watched hit for a 1 to 3 plus risk to reward. It just hit beautifully, everything lined up. And in this video, I'm going to break down exactly what I was looking for, all the rules I have for trading the 1 minute, everything I look for, the confluences, just everything I go through. So make sure you stick around till the end of the video. You need to know that the 1 minute fakes out a lot, but there are ways to get around and avoid all the fake outs. And I'm going to go over there's non-negotiable rules that I have, which you have to stick to avoid fake outs and just try and catch the best setups. The first non-negotiable rule, it has to be a high probability supply or demand zone. If you do not know what high probability zones are, I do have a video about it and I'm gonna put it up onto the screen right now. Make sure you go and check that video out and then come back to this one. But I'm gonna just do a quick explanation of what high and low probability is. So with this demand right here, you can see that there is a gap right out of it. So as soon as we get the demand that gets created and we get that big push to make the demand actually valid, it has to leave behind a gap. Just like this setup right here, I'm actually going to remove everything just so you can see a little bit more clear. There is a gap right there. And that's what we need for every single one of our supply or demand zones. The next non-negotiable rule, it has to have a breaker structure. Our supply or demand has to have a breaker structure. Like, let's look at this setup, which I caught yesterday. And it is out for a live trading video if anyone wants to go and watch me take this video live, or this trade live, sorry. There is the breaker structure. We broke this high to make this valid. Every single one of my zones have to have a breaker structure. Now, with trading the 1 minute, I am only trading GU. I still do trade regular 5 minute supply and demand with all of my other pairs, NAS, GU, GJ, and gold. But on the 1 minute, I only trade GU. Reason is because I have low spread on GU. GU just moves cleanly. It respects 1 minute supply and demand better than the other 3 pairs that I've listed. From personal backtesting, GU just hits way better than the rest. So that's just why I only stick to GU. And a lot happens on the 1 minute. There's going to be a lot of zones that you see. And if you're looking at 4 pairs, you're going to end up taking like setups that aren't the best because you see them happening. That's why at the 1 minute, I only stick to GU. But it does actually still work on other pairs. I just prefer to stick to one pair. The third non-negotiable rule I have is that my supply or demand setup has to be below or above the 200 EMA. So in this example, it's a demand, which means we have to be above the 200 EMA. So here we can see the white line is the 200 EMA, or this, yeah, 200 EMA, and we are above it. If it was a supply, we'd have to be below it. Let's say we were downtrend, and that's where our supply would have to be. It would have to be below the 200 EMA. That is moving on to the next rule, which is we have to be following trend. But this goes in with the 200 EMA because most of the time when you're following the 200 EMA, you are going to be in trend. So if you're just trading above the 200 EMA, we're probably bullish for the day. So we technically are following trend. So you have to be following trend no matter what. Just trust me on this. You can backtest it. You might see the most beautiful counter trend supply setup on the 1 minute, and it will just end up losing. It can check every single box. It can be the most perfect setup, and it will still end up losing if you are taking counter trend setups on the 1 minute. Just trust me on this. Follow the 200 EMA. That's all you need to do. Just follow trend. Follow the 200 EMA. If price is trading above the 200 EMA, only take demands. If we're trading below the 200 EMA, only take supplies. Just trust me on that. Now we start getting a little bit more deep. The fourth rule is that you cannot be taking supply or demands that are too high or too low unless there is higher time frame confluence. If we are only taking a 1 minute demand, you do not want to be taking demands up in this area here. Up in this area here, I'd say that is too high. And you wouldn't want to be taking supplies when we are down in this area here. This is just looking at price, like nothing else. We can't really tell unless we start looking at other things. But let's look at why I say price is too high here. So this indicator right here, as you can see where it goes light gray, that is the beginning of New York session. So everything here where I took my demand kind of made sense. We're not too high. New York session just started. It kind of makes sense. Like, we look bullish on the higher time frame to end up taking like demands. In this case, the setup that I took. So taking a demand at the beginning of New York session kind of makes sense. We haven't really been pushing up for too long. Like, New York started, we haven't broken London high. It kind of makes sense. There's nothing really to show us that we might not end up like hitting. But then once we go later into the day, you can see that we've been bullish for quite some time now. You can see that we've been bullish for quite some time. So it kind of does not make sense to take demand up in this area here. It just makes no sense. And it would be the exact same thing if we were bearish for the day. Let's say London dropped, beginning of New York was also dropping, and then getting towards like the middle of New York session. It doesn't make sense to take supplies if we were bearish, because we are going to eventually get a reversal, and that's what ended up happening. Towards the end of New York session, we ended up getting a reversal. Obviously, this is just looking at the chart. We already know what's happening, so you can't really say anything about it. But if I had to have seen this on the day, let's just make this a little bit clear. If I had to see a really good demand up like in this area here, I'm going to be careful about taking it. Up in, even getting past like these highs up here, I'm going to be careful when taking a demand, because we know that we've been bullish for quite a while. The whole of the beginning of New York session was bullish. So the rest of New York session, we can't really be looking for another demand, because we're not sure what the rest of New York session is going to do. So you don't want to be taking supply demands with if we are too high or too low. Just be careful about that, because a lot of them will fake out and there is reversals eventually gonna happen. Don't get me wrong though, some demands could end up working and we could even start trading a little bit higher. Like, let's say for an example, let's say we had a demand, I think, yeah, he has a demand. Actually, he has a perfect example of one getting faked out. That's actually, it might have won. I'm not, no, okay, that looks like a loss. Here is a valid 1 minute demand, and you would have gotten in that break of the candle, and wherever your stop loss would have been, you would have ended up losing this trade because we are too high. You can see we're way too high. That's a perfect example. But there is going to be some cases where this demand actually still ends up winning and we still continue trading up higher. But that doesn't happen too often. I'm saying for majority of the time, we are eventually going to get a fake out when we've been bullish for way too long, or if we've been bearish for way too long. So you need to be aware of that. That's why I had this supply marked up, but I didn't end up taking this because it didn't follow my rules, because we were a little bit above the 200 EMA. We were cutting through it. So that's why I did leave the setup alone. If like the 200 EMA was like, let's say it went like this, then I would have taken this supply here. But as you can see, it did not do that, and we were a little bit like below it, so I left the setup alone. This supply did make a lot of sense because of where we were with price. We were very bullish the whole of New York session. Getting to the end of New York session, we're starting to get a reversal, so it kind of made sense on the 1 minute to take. The next rule I'm going to talk about is entries. And with 1 minute supply and demand, you want to be very careful. On the 5 minutes, you can get in aggressive because it just makes a lot more sense to take aggressive entries if there's a good reaction at the zone on the 5 minute, because those ones usually do end up playing out sometimes. But on the 1 minute, I'm just going to be honest with you guys, do not take aggressive entries. I promise you, you will get faked out so much. Just leave aggressive entries alone on the 1 minute. Just don't even think about aggressive entries. Like, look at how good this reaction was at this 1 minute zone. I promise you, this could have faked out with even that beautiful reaction. So just, you want to leave aggressive entries alone with the 1 minute. The only way I enter is at break of candle. So we're going to get the candle that taps into the zone, and now at this point in time, our break of candle would have been like this. That would have been our entry, but we didn't get that entry, so our entry moves down to the next breaker candle, which is there. So this would have been our entry, which was my entry, and you would have gotten in at once we broke this candle, right? That would have been our entry. But now moving on to the next rule is your stop loss placement. You want to have your stop loss 1 pip below, even 1.5 pips below the wick or the candle that taps into the zone. So as you can see right here, this red wick was tapped into the zone, so we need our stop loss to be 1 pip below this. 1 pip below this bottom wick here is where our stop loss is going to go. Even 1.5 pips depending on how you feel, but I'm pretty comfortable, and from what I've tested, 1 pip does work pretty well. So at this point, our stop loss is 1.3 pips from entry, and now we're just going to drag it down to 2.3 pips, which would have been right there. That would have been, this was actually my stop loss placement when I took the live trade. If you guys want to go watch that, the video will be on screen now. That was my stop loss, and I got in that break of the candle, and you could have taken it for whatever you want to take it for. Now moving on to the next rule. I only look for 1 to 1.5 unless I'm very confident that we are going to keep pushing up. So 1 to 1.5 is my first take profit no matter what. Not 1 to 1 like the 5 minute. I'm looking for a 1 to 1.5 on the 1 minute, because most 1 minute supply and demands go for way higher than a 1 to 1.5, and I just saw that a 1 to 1.5 is what I could get consistently. That's why I'm happy with that take profit. I could even move it up to 1 to 2 pretty soon because of how good the 1 minute hits. But I'm pretty comfortable with 1 to 1.5. And I do try and hold a little bit longer than a 1 to 1.5 in each of my setups. And I'm just going to tell you guys, it hits. Like this trade that I took yesterday, if I held this, damn, this would have been an absolutely crazy trade, because it just continued up for like the rest of the day until it started consolidating. But you could have caught like, what is that, a 1 to 5 on this trade. That's why, yeah, I'm just happy with this. So stop loss 1 pip below the candle or the wick that taps into the zone. Breaker candle entries only, and I'm looking for a 1 to 1.5 minimum. That's my first take profit. And if I want to hold, I'm gonna probably look for a 1 to 2, maybe a 1 to 2.5. And also, if there's gaps on the higher time frame, you can hold to cover that, because most of the time the 1 minute will cover them, and then you can get like a higher risk to reward. The next thing I want to go over is looking for higher time frame confluences, like looking for 5 minute liquidity grabs to mix into the 1 minute. Like you could get a 5 minute liquidity grab and you could look for a 1 minute demand. I am not taking liquidity grabs off the 1 minute. Please just take note there. No liquidity grabs off the 1 minute. But if we have a 5 minute liquidity grab, I'm going to look for a 1 minute demand. If we have a 15 minute demand, I'm going to look for a 1 minute demand inside of that or a little bit later to be created. And same thing with the 1 hour. You just want to be looking for higher time frame confluence. You want to be looking for gaps on the higher time frame all the time, because the 1 minute does tend to push up to those and fill them in. Now this is an example of using a 5 minute demand and scaling it down to the 1 minute, which you could have done. I did miss the setup, but I took one later in the day that ended up winning. So this was on Tuesday. So let's just go to the 5 minute. All right, let's look at this. This is just a regular 5 minute demand. This is just demands we take all the time. We see this happen all the time. This is just a regular, plain and simple 5 minute demand. We know it wins, whatever. We're gonna go to the 1 minute, and we can see that we can scale this zone down to the 1 minute. We could have used this as a 1 minute demand zone as well. And if you have a 5 minutes and you can scale it down to the 1 minute, you want to be looking for more than a 1 to 1.5. You want to be looking for a 1 to 2, a 1 to 3, and it depends on the momentum and the volume. You could be looking for even higher, like a 1 to 4 or a 1 to 5 on the 1 minute. Now let's break this down. You would have entered, I'm just going to delete the 5 minute zone. We know we're in a 5 minute zone, whatever. 1 pip below the wick that tapped, the lowest wick in the zone, which is 1.9 pips. So our stop loss would have been at the bottom of the zone. We would have gotten in. Now, our first take profit would have been at 1 to 1.5, which got hit perfect. But we're in a 5 minute zone, so we know we can actually end up holding this for a little bit longer than a regular 1 to 1.5, because look at how high this went up. We're following trend, we're in a 5-minute demand. It makes sense to end up holding it for longer. You could have held it for this high up here for a 1 to 2.8, or you could have just ended up holding it for a 1 to 3. Just when we have higher time frame confluence, those setups tend to hold even longer. You can hold for a higher risk to reward. So you want to be looking for high time frame demands, gaps, all that type of stuff. Where liquidity is, you want to be looking at the higher time frame for those things, and then look for 1 minute demands or 1 minute zones just to hold to those things. And fill in gaps, grab liquidity, and stuff like that. These are all the rules I use on the 1 minute to avoid fake outs, to find the best setups on the 1 minute. You need to be aware, the 1 minute fakes out quite a bit, so you need to be following these rules. You have to be extremely strict on your rules, and all the rules I've gone through, else you are going to get faked out. But once you start perfecting this, I have not perfected this at all. I'm still learning, but I thought I might as well just share with you guys, because the past couple of trades I've taken and I've posted on YouTube have been absolutely crazy winners, and a few people have asked me about it. So I decided to make a video for you guys, but you need to be super strict. If you guys have any questions, you can leave them in the description, or the comments, sorry, or you can DM me and I'll get back to you guys. But the 1 minute, it hits really well. I'm gonna just go over all the rules again, just so you guys make sure you know them, and it's a lot simpler way just to keep track of all the rules. All right, the first rule is it has to be a high probability zone. Second rule, it has to have a breaker structure. Third rule, if we are taking a demand, it has to be above the 200 EMA, exactly like this right here. We above the 200 EMA, the white one. And then we have to be below the 200 EMA when we are taking a supply zone. We need to be following trend. The zone cannot be too high or too low. You have to learn and determine how to tell if a setup is too high or too low. I can't really explain it unless you're taking the same setup with me, which you can if you join the Discord. The fifth rule is the stop loss needs to be 1 pip below the wick or the candle that taps into the zone. Only break a candle entries. I only trade GU, and the next rule is you need to be looking for higher time frame confluences, like I have been saying. Those are all the rules. That's all I got in this video. Make sure you guys keep grinding, subscribe, like this video, comment, follow my Instagram, join the Discord. But that's all I got. Make sure you guys keep grinding, keep getting to the next level, and I'll see you guys in the next video.